let's get right into it. We're talking about the ultimate investing showdown. In one corner, you've got the old school champion mutual funds, and in the other, the quick, modern challenger ETFs. Now, they both seem kind of similar, right? They pull your money to invest. But believe me, the way they work is totally different, and that difference can have a huge impact on your wallet. So that's the big question we're tackling today. Which one is the right home for your hard-earned money? By the time we're done here, you're going to have a super clear idea of which one fits your style, your goals, and your wallet.
Okay, so before the first bell rings, we've got to know who we're dealing with. Let's meet the contenders.
First up, the mutual fund. Picture this, thousands of people, all chipping in their money into one giant pot. Then, a professional fund manager takes that pot of money and actively tries to pick winning stocks and bonds to get you the best possible returns. It's the classic, hands-off way to invest, and it's been around in India forever, since 1964. And then we have the challenger, the ETF, or exchange-traded fund. Now, it's also a basket of investments, but here is the absolute game changer. You can buy and sell it on the stock market all day long, just like a single stock. And most ETFs, they're not trying to beat the market. They're trying to be the market by just copying an index like the Nifty 50.
All right, now that we know the players, let's get this showdown started. We're breaking it down into 3 decisive rounds. Round 1 is all about how you actually buy and sell these things. With a mutual fund, you get one price per day, calculated after the market closes. It's called the NAV. But with an ETF, it's live. The price is bouncing around every single second the market is open. You see a price you like? Boom. You can buy or sell right then and there. That gives you a ton more control. Okay, now for a really, really critical round, the cost. Because mutual funds have that active manager making decisions, they usually come with higher fees. That's the expense ratio. We're often talking 1 to 2%. ETFs, on the other hand, since they're just passively tracking an index, have way, way lower costs, sometimes as low as 0.05%. And that difference might sound tiny, but trust me, it is not. And this number right here, this shows you just how massive that tiny difference can be. Let's say you invest 10 lakh rupees. A seemingly small 1.5% difference in fees every year could actually gobble up over 15 lakh rupees of your potential profit over 20 years. That's insane, right? It's the silent power of compounding fees working against you. So our final round really boils down to the core philosophy. Most mutual funds are playing an active game. The manager's whole job is to try and outsmart the market, to pick the winners. ETFs, on the other hand, are mostly passive. Their goal isn't to be better than the market, it's just to deliver the market's performance. It's like the difference between trying to be the star cricket player versus just owning the entire team.
Okay, the rounds are over. We've seen the strengths and weaknesses. So, who wins? Well, the truth is, the winner is completely up to you and your investing style. It's time for you to choose your champion. Let's make this super simple. If you want something hands-off, if you love setting up your monthly SIPs and you believe an expert can find those hidden gems and beat the market, then a mutual fund is probably a great fit for you. But if your number one priority is keeping costs as low as humanly possible, you want that real-time trading control, and you're happy just getting the market's return, then an ETF is almost certainly your champion. But wait a second. What if I told you the smartest investors don't actually pick one? What if there's a more advanced way to play this game? A pro move that actually uses the best of both worlds. So here it is, the big secret. You don't have to choose a side. The best strategy is often to use both. Think of it like this. You build the solid, reliable core of your portfolio, maybe 70% of it, with a super low-cost ETF that just tracks the whole market. Then, with the other 30%, you can get a little more aggressive, using a specialized, actively managed mutual fund to hunt for those high-growth, small-cap stocks, where a great manager might really make a difference. And really, that brings us to the final thought. It's not just about having a portfolio. It's about making sure it's working as hard as it possibly can for you. So, now that you know the real differences between mutual funds and ETFs, take a look at your own investments. Are you using the sharpest tools in the shed to build your wealth? The choice is all yours.